Now friends, we'll find out or we'll learn about what is meant by total revenue. Total revenue mentioned with the reference to letters as TR is equal to price into the quantity sold. It is nothing but the sale proceeds of a firm. Number of units sold into unit price, that is price per unit. In very few goods where the elasticity of demand is perfectly elastic or perfectly inelastic, the seller raises the price of the goods. When the seller raises the price of the goods, there are two effects. What are the two effects? One is price effect and the quantity effect. That is, they act in opposite direction on the revenue. What is price effect? If after a price increase in each unit sold lowers the revenue or raises the revenue, it is called as price effect. That is, when a unit is being sold at either a higher price or at a lower price, tends to raise the revenue or lessen the revenue, it's called price effect. That is relation with the price and the revenue. Next is quantity. After a price rise, some more units are sold, which tends to either reduce the revenue or which tends to increase the revenue. This is called quantity. That is, revenue in accordance with the quantity is called quantity effect. Revenue in accordance to the price is called as price effect. What will be the net effect on the total revenue? We should see both the price effect or the quantity effect and realize which is stronger. If the price effect is stronger, then the revenue will go up. If the quantity effect is stronger, total revenue will come down. If a reduce in the prices increases the quantity, though the quantity increases, revenue will come down. So, if the quantity effect is stronger, revenue will be less. Whereas, though after a price increase, if even after the increase of the price, the unit is sold at the same level, our revenue will increase, then that is best. We will get more revenue. So the price elasticity of demand tells us as what happens to the total income obtained by selling with accordance to the change in the price. Its size determines the effect of the price or the quantity, whichever is stronger. Say for example, if in case the demand for a good is unit elastic, that is, the price elasticity of the demand is equal to 1. See to the figure number 9 in page number 2.34. An increase in the price, like from OP the price shifts to OP1. Increase in the price does not change the total revenue. The product demanded is shifting from OQ to OQ1. Though the price increases, the quantity demanded decreases, thereby decreasing the revenue. The total revenue does not change, the quantity demanded changes. In this case, the quantity and the price effect equally balance each other. When price rises from P to P1, the gain is equal to the loss in the revenue due to the sales lost. That is, the quantity is reduced from Q to Q1. So the loss in the revenue is that gap that is shown in the capital B. The rise in the prices is shown in the revenue column, like gain in revenue, that is area B. Now you can see the both squares are equal. So the loss in the sales value is equal to the gain in the revenue. That is, though the lesser amount of the commodity is being sold, you are able to get the same revenue as of the old sales. So this is called as EP is less, that is equal to 1, unit elasticity. Supposing if the demand is inelastic, that is the price elastic of the demand is less than 1, a higher prices increases total revenue. The quantity effect here is weaker. The price effect, on the contrary, when demand is inelastic, a fall in the price reduces total revenue because the quantity effect will be more than the price effect. Now, this example, we can refer page 2.33, figure number 8, 2.31, figure number 8E. And in the case, if the demand for the good is elastic, that is, the price elasticity of demand is greater than 1, an increase in the price reduces total revenue, and a fall in price increase in the price reduces total revenue, and fall in price increases total revenue. In this case, the quantity effect is stronger than the price effect. This is explained in figure number 8D. Totally, we can summarize this relationship between price elasticity and total revenue as such in the table given in page number 2.35. Now see, price increase when it is elastic, the total revenue decreases. When it is unitary elastic, the total revenue remains the same. When it is inelastic, total revenue increases. Though there is a price increase, the total revenue decreases in case of elastic demand. In case of unitary elastic, the total revenue remains the same. In case of inelastic, total revenue increases. In contrary, when the price decreases, in the case of elasticity of demand, when it is elastic, the total revenue increases. When it is unitary elastic, the total revenue remains the same. When it is inelastic, the total revenue decreases.